My name is Juliana Hess. I'm one of the co-founders of the Oxford Impact Collaborative. Welcome to our last fireside chat of 2022. This is a two-part conversation with three private equity funds about their perspective on impact investment. Thank you for joining. Those of you joining us for the first time, OIC is an informal organization founded by a group of Oxford alumni who met while pursuing studies in the various social impact programs at Said Business School. We are a group of global executives, leaders in finance, private equity, healthcare, fintech, proptech, insurance, family services, asset management, and law. We represent 5 of the 7 continents. We are joined by a common desire to advance the idea that it is possible to do well by doing good. Our goal is for our members and speakers to have a safe place to engage in an open and constructive debate. With that in mind, the views expressed here are those of each individual and do not represent views of their organizations unless otherwise stated by the participant. Please feel free to use the information learned during this event. However, neither the identity nor the affiliation of the speakers or participants shall be used in public, unless, of course, each of the participants expresses otherwise. This 1-hour session will be recorded. As customary, there will be a Q&A session at the end, and we encourage you to type your questions via chat. It is my pleasure to introduce to you our moderators, Richard Piliero and Greg Robbins. Richard is a fellow Oxford Said Impact Program alum. He's a managing director at global private equity firm Franklin Templeton, and he's based in Dubai. Greg, also an Oxford University alum, is a financial services veteran with over 30 years of experience in various roles at startups and global organizations in the US and Europe. And to our fabulous panelists, Ann Doe and Bo Sale of Dubai-based Patamar Capital. Patamar is Southeast Asia's leading impact-driven venture capital firm investing in early-stage companies building sector-defining platforms that maximize positive impact and financial returns. Justin Fire and Tom Johnson of US-based Timberland Investment Resources, an international investment firm founded to unlock the value of the world's forests. Timberland manages over $1.6 billion of timberland assets for institutional and high net worth clients, comprising over 800,000 acres of forest land in 15 different states. Last but not least, Walter Fonseca, Lucas Fonseca, and Jerome Hoane of Finova, a Geneva-based renewable energy investment fund focusing on greenfield, brownfield, and repowering renewable energy projects in Southern Europe. For the audience convenience, you can find links to all the bios and the companies in the chat. I want to start by saying thank you to each of you for being here today. You're all global leaders in your respective fields, and you all have been championing impact investment in different forms. Thank you for taking the time out of your crazy schedules in the spirit of collaboration. Robert, Greg, Richard, the floor is yours.
Okay, thank you, Juliana. I think I'll kick things off here. In the audience, and thanks everybody for tuning in. I think we'll probably have a mix of interests and a mix of knowledge and familiarity with some of the impact concepts and investments. So I think we start with a big picture question, and all of these questions go out to all the panelists. So it's really whoever wants to jump in. The whole topic of sustainable investing, impact investing has gotten a lot of attention. And in the last period of time, there's been a lot of headwinds. So a few years ago, we might have had quite a different conversation about it. And so post-pandemic, in a rising rate environment, with energy becoming more, looking a lot better in the markets, with some of the growth stocks getting hammered, and a lot of the just the noise around ESG investing in public markets as well. I guess the question to everybody is to get everybody on the same page. Maybe the panel could address why, given all these headwinds right now, is it a good time to think about impact investing? Anybody who wants to start?
Yeah, sure. I'll give it a quick stab. Can you hear me well?
Yep.
Great. We've been in this game for now, about 15 years. And so we've seen different environments and different return expectations. I think that one, just from the standpoint of where we are with many of the major challenges that we're facing, there's almost a little bit of a resetting of what can be viewed as some sort of reasonable return expectations after some very, very large run-ups in the venture capital and tech markets, where valuations and multiples got crazy. And there were a lot of great businesses being built with an impact core and thesis that weren't, I guess you would say, the sexiest thing out there at the time, but were great businesses, strong cash flows, strong profitabilities, and strong growth potential, but we're not kind of the soup du jour when people were looking at it from a tech side. So from our perspective, there's still great businesses to be built based on good fundamentals and not kind of belief in something that may or may not ever come true with venture type returns, but we're not maybe talking, the 10,000x type returns. We're talking about, good core businesses that, can be acquired and be built into profitable long-term companies. And so we still think that the opportunities there, and a lot of times those businesses never got bid up really high. And so they've kind of just continued to run the course. And so we think now, good of a time as ever for people to actually reset their return expectations a little bit and actually invest in good businesses.
Through the filter of impact, right? So we're saying,
Right.
within that universe, impact. So maybe somebody could take that point a little further on impact and why that filter makes sense today.
Definitively, Walter here
Hi, Walter.
from Finpact and Finova. Clearly, impact these days is resuming all the expectations of the different players that we created in the last 10 years. We started in 2012 with Finpact, and we were very few and very realistic. But right now is, as we expect, a strong investment avenue that everybody is needing to be, and the pension funds are more inclined to be. And as our fellow said, is not only a demonstrative thing, is strong investment discipline with good deals, with good returns, that at the same time make a lot of social impact and a lot of environmental impact. Because the time is coming that we try to put all together our values and our job and our results and our things. And I think that the time is now. In Finpact and in Finova, we are trying to impress all our projects on this type of values and orientation. And Finova, for instance, is in clean energy. And in clean energy, you can do things in all the meanings, no? Because we can create another green bubble with all the money that is going around, trying to do conscious projects that really have good impact on the community, on the nature. That is not the same.
And maybe if I can add one more thing is, now nobody's looking at your quick 1 to 2 year to return in and out, sell off on the secondary when you pump up a seed round to a series A to a series B. Nobody's looking to get in and out with high returns that fast. So we can actually say to ourselves, investing into longer term businesses that are on the impact side, truly trying to change the way that markets function, trying to change the way that industries function. So as we're looking at clean energy, as we're looking at, changing the agricultural sectors in the food industry, if we're looking at, financial services for underserved populations, these businesses oftentimes take quite a while to get to a critical mass. And now as, timeframes to build these businesses and return expectations when it comes to speed and velocity start to slow down, everyone can start saying, hey, let's make some longer term bets and let's get back to those fundamentals of why we started doing venture and private equity in the first part, which is just building great businesses that are going to transform industries.
Let me ask the question in a different manner then. What do you say to the skeptic who says, the world's changed, we're in an environment where we can actually get real returns on capital, through basic deposits and things, and there's, some money is not free, sectors that are not neatly in impact and sustainability are on the rise. Why should we exclude those things, and why should we accept maybe much longer term payback period on some of the growth investments? Why should we do that?
if I may, I think there's a common shift in society that is looking more and more for purpose in terms of consumers and in terms of what the new generation is looking for in a product. It is actually a safer bet to invest in a company that has a product with purpose that the consumers are going to see it the same way, because the brand building and the stickiness to consumers is going to be a lot higher and a lot stronger. So I think, of course, right now we're in a good moment on the markets, especially for private equity and venture capital. I think it's pretty much what saved everyone's year last year. The stock markets and the quick returns are on the downside. And building businesses that make sense is just good for business, in our opinion.
I would like to just follow on from that point and just ask what is a broader question, is what degree of trade-off is there between return and impact? And at a fund level, where is impact in the process, the investment process? Is it looked at first, or is it looked at alongside the financial return? So the two-step question there.
If I may, I think impact is looked first for us. We've been doing impact since probably before it was called impact investing. For us, it was just common sense. And I think if a deal makes sense to us, it has to have some sort of purpose. As I was saying before, good business is good for business. So when you have a product or a project that actually adds value, that value will automatically go to the bottom line, and it will create better financial returns. What we've been pushing for many years now is to find those projects and changing the contemporary and the normal business models that are out there to make these impact projects more profitable than your standard project, because it has more to add. So for us, is the first thing we look at it, and from a common sense perspective, is this helping or not? Then we obviously get into the metrics and we get into the analysis and we do our reporting and everything, but it really starts from a matter of common sense.
Yeah, and so it sounds like that there is not so much of a trade-off, but you see it as a catalyst for more return, for higher return. Is that shared? I guess in you, Bo, and Tom as well for your funds.
Yeah, I think so. Speaking from Batama, basically we target both top-tier financial returns at the same time as delivering great impact outcomes to the low and middle income consumers, as well as the small and medium enterprises in Southeast Asia. So in our investment process, we conduct both commercial DD as well as the impact DD in parallel. So we do not compromise one for another, and they have to go hand in hand. There are cases when we have to reject an investment just because we don't think the impact due diligence result makes sense for us to come in. It doesn't fit with the fund's mandate. And from our past investment experience, including our most recent divestment and exit this year into from an e-grocery platform in Indonesia, we were able to exit via secondary sale, and the company delivered roughly a 12x valuation uplift in 4 years. So I think that's a good example to illustrate that we do not compromise one for another.
Yes,
Totally agree.
And I can just add a little bit of color for Timberland Investment Resources, or TIR. For about 20 years we've been around, we've been investing in timberland in the US and building out some processing, a sawmill. And for that, it was all sustainable forestry focused, so very strong ESG risk mitigation. But more recently, we've been focused on developing an impact strategy that will be impact first. So there is a trade-off. We're talking about much lower returns, focusing on impoverished and struggling areas in the US South. And unlike a lot of timber managers where they're focused mostly on buying timberland and managing the sustainable growing of trees. And then maybe some ecosystems services or natural capital ways of enhancing that return, like with solar development and wetland mitigation, which we are doing in our traditional forestry. But this new impact strategy is going to focus on a much lower return, going into areas and building out a forestry market in those areas and connecting the local community to that wealth creation. So right from the get-go, the local community would have some type of share of profits, and then as wealth is created over time, because these are either fledgling wood markets, or we would have to create a full wood market from the timberland to the initial processing and any secondary processing like furniture making. And then the supportive services needed for that, the logging labor force, the trucking labor force, all of that. We're talking about linking in the local community to that, not only with jobs, but with a share of the profits, which is very uncommon for a lot of the natural resource management, especially in the US South.
So just to follow on that, so there's an alignment then with the investor base that they understand that trade-off, right? That there's not an expectation that there's a preeminence for returns. It's first impact and a willingness to sacrifice. And how does that work well in creating that alignment?
Great question, Greg. They are very much aware. I just came from the Mission Investors Exchange and annual conference, US-based membership network of mostly private foundations, and they held their conference last week. And there was one of the themes was impact first, looking for really hitting it out of the park on impact and taking less of a return to do so, because historically a lot of impact strategies have tried to wrestle with that market return and deliver less on the impact, which I think a lot of impact investors are starting to look at concessionary return for much more impact. I mean, you have to have a lot more impact to justify that. So I'm not saying that it's an easy trade-off.
Very interesting. I was going to change it a little bit, the topic. Does anybody else on the panel want to jump in on this topic on measurement and trade-offs with financial returns and impact returns?
Well, maybe I'll just add one thing to what Justin was saying, because I think he brings up an incredible point, right? In our history, we've kind of used every tool in the toolbox, and a lot of it has to do with market timing. A lot of it has to do with market efficiency. So, at Palomar, we're investing in Southeast Asia primarily, and we're longtime investors before that in the microfinance institutions in India. So you're talking about massive market failures for financial inclusion, SME enablement, and some different things. But then when we start looking at other markets, or the timing of when we thought about entering some other markets in Southeast Asia, we said, actually, from a risk return perspective, we need to be, if we're going to do a certain type of deal, which we did out of some special purpose vehicles, we knew that the return profile would probably be lower, and it would be an impact first approach at that time due to certain market dynamics. There weren't payment systems in place. Nobody had mobile phones. Data was expensive. And so we knew the gestation period on some of them would be quite a bit longer. But then in our other more blind pool funds, we recognized that, hey, the market is ready for this, but we cannot go into a few geographies and economies. And so we always say there's like a portfolio risk when it comes to both financial and impact returns, based on business models, based on market opportunities, based on timing. And then there's just certain types of business models which will never truly be, super scale type businesses with venture type returns. And so it doesn't mean it's a bad investment, but it also probably means sometimes that the risk may be lower because it's more of a nuts and bolts type business. So when it comes to impact, there's all the tools in the toolbox. There's every risk profile you can think of. It's not always market rate, when you do a risk return analysis. I think that for the audience, just to know that, you just need to know what the fund manager is and what the investor is looking to go into the fund, or if you're just going individually into a company or some sort of a scheme, you just need to make sure that you're aligned with what the investment strategy is and what the risk return profile is.
Thank you for that. Actually, to come back to the opening question, in this kind of rising rate environment, right, which changes a little bit the dynamics for longer term investing and increases the cost. How is that impacting, so to speak, all of you as you position these in terms of investor willingness and patience to wait out returns when the cost of capital is going up? Is that playing a role? I mean, as rates are going up to 4 or 5% in the US and getting there in Europe?
Well, it obviously plays a role. There's a shift. There's the natural shift of capital towards fixed income and different risk return for private equity or venture capital. In our specific strategies, we are actually hedging that with our energy strategy and Finova, which should work as a counter-cyclical investment for most of these investors. So by developing energy projects, which is pretty much the major financial crisis, where the source of the financial crisis we're seeing mainly in Europe at the moment, that acts as a hedge towards those investments. But yeah, the market is completely shifting. It's taking longer and longer for investors to commit to projects. Everyone is cautious and analyzing more in depth their situation, and especially covering holes on other ends.
Anybody else addressing that?
I could just add perspective on just timberland in general is when you look at its fact that it's correlated to inflation, and so as inflationary pressures have risen, timberland investment has actually increased. So it's more of an inflationary hedge in an investment portfolio. So that part of it is definitely playing out here. But given that we're talking about building new markets and investing across the value chain of forestry market activity, we're really looking out longer term here, and it's going to cost more to build out, say a sawmill and some of these supportive services, just the wage pressure and the cost that would come with that. But we are. In our strategy, we have what we call a grant sidecar, where the investors, these are our target investors, are large foundations that oftentimes will enhance their investment into an investment strategy, an impact strategy like this with a grant, and so that will help cover some of those higher costs like workforce development and the build out of that supportive services.
Okay, thank you, Justin.
And
Richard,
Greg, maybe
I don't want to monopolize.
Okay.
Oh, go on. Sorry, go on.
Yeah, I mean, one thing I would add is just to think about it more as a maturity of the fund manager meets the asset class. So I don't think that you're seeing a slowdown or a speed up based on anything. When it comes to folks who are going after commercial types returns, they're not going to look at impact differently than they would look at something else, unless they're just skeptical of the fact that you can do impact and financial returns, simultaneously. If they're in that part of their journey, then yes, maybe people will be a little bit more discerning because it's a story they don't know, understand, and haven't invested into. But for fund managers who've proven performance, both on the impact and on the financial return side, which there are quite a number in the impact space, it's just more of an asset allocation play. And so it's going to move in correlation oftentimes. Once you move beyond foundations and you move beyond maybe development finance institutions and others, it's just going to move up and down based with that mix that people want to have exposure as the markets shift one way or another. So
the headwinds are for everybody, basically.
Yeah, I mean, I just tend to think that impact, people used to think about impact investing as an asset class. I always say that it's not an asset class. Like, we have asset classes already. What it is a lens of how you want to put your money to work.
Excellent. Yeah. That's a great way of putting it. Richard, did you want to jump in?
No, Bo just jumped on one of the questions I was going to have, is what is the most common misconception of that asset owners may have to each of your funds or impact investing, and Bo, you just mentioned that exactly. And I want to reach out to the other panelists to see if there are other points there. And that's a first point to just first question. What would be the most common? There's something you'd like to say to the asset owners about common misconception?
Good question.
Sustainability is something that not always is well understood, and sustainability sometimes is only referred to the environmental things. And sustainability in a project like this that is consciously conceived is sustainability in all the meanings. Then financial sustainability, commercial sustainability, community sustainability, and all the different aspects. And some of the investors imagine that some of these categories are in the philanthropy side, or in the or they need some help, or some other things. And as our colleague just referred, good managers are proving that it's possible to create a lot of impact, a lot of sustainability in all the meanings, or in most of the meanings, with extraordinary good returns. Extraordinary are normal, are not ridiculous, but well-conceived things are really important. And some of the family offices, some of the institutional investors, some of the fund of funds are starting to value these type of things, but still a lot that have these misconceptions and put the impact investment more in the philanthropic venture side than in the real investment with purpose, as we try to do.
Thank you.
Yeah.
And just, sorry, were you going to say something, Lucas?
No, and I think it's just like Walter said, it really depends on the category of investors and their profiles. In our experience, it's a lot easier to deal with family offices who share some sort of family values and have some purpose with what they want to do with their money. And in some other cases, like a fund of funds or more institutional investors, they just have tick lists, and they know they have to allocate X amount to impact, and they define impact with the certain metrics and everything, which makes things slightly harder. But in the family offices and the family industries, you really see people trying to put their money to work in something that has a meaning.
And that brings up a good point, and just putting on an asset owner hat, even though I'm sitting from the fund management side, but some of the asset owners, when they ask us, it's really as they put their capital in and they already are well versed in impact and they would like to drive impact. What type of reporting do each of your funds bring to show, just as like the financial returns, that the impact that has been spoken about is being achieved, and to what level? And there's, as we know, there's a wide toolbox of different measures and conventions, but it would be great to hear from each of you how you approach that reporting.
In our case, sorry to continue talking, but in our case, it's totally embedded. And the financial reports are standard private equity reports to LPs that, as you know, are very, very deep and very, very strong. And at the same time, in the same report, you have the impact report. We do it with using IRIS as one of the protocols that help us the best, because help us to define the KPIs that we will report and monitor in each project from scratch. And we have the help of a firm in London that is Business Valuation International, that have a specific division on IRIS and impact report that help us on that report. Then for us, it's part of the same. It's like Deloitte as an auditor. No? It's not a different thing. It's not a separate concept. It's not some. It's part of the normal report that our LPs are requiring, and they are very exigent on that.
Yeah.
As if I may add as well to what you were saying, we really like the aspect of using an independent analysis on this, not providing our metrics and for the financial and the impact measurement sides. It's very helpful on our side to provide third-party neutral analysis to our investors.
And you had a comment.
Oh yes, no, I was just going to share more about the way that Patama looked at impact. So as mentioned before, we look to do impact due diligence as part of our due diligence process when evaluate an investment. And as part of that process, we pretty much identify exactly what are the focus of portfolio company. We work very closely with the founding team to identify what we call an impact DNA. So that intent to do good. So that must exist first before we can proceed with all the parts of quantifying the depth and the scale of impact. Upon signing and upon investment execution, a part of the documents that they have to sign is a site letter, which specifically give us the right to work with them over a 6-month period after closing to develop a set of impact metrics which do not interfere with the operational and the day-to-day activities of the company. It just doesn't ask them to go out and do a weekly customer survey, etc. So it will be embedded within the financial and the operational reporting, and it's kind of help build and cultivate an impact culture within the portfolio companies as well. And this is what we target to strengthen the intent. And then the methodology that we use and the set of reporting metrics that we use are largely based on a framework we developed with Jin. It's also IRIS Plus, something that Walter just mentioned. So we're one of the founding members of the Global Impact Investing Network. So this is why we've been working with them to refine our internal reporting. And we have a dedicated operations team to take on the reporting. With our investors, what we have found is that our impact reports will be published on an annual basis. And we have seen a variety of degrees, but most of our LPs are extremely keen to find out. And sometimes they even make comments of how they would like to see impact being generated for the upcoming year.
Great approach. Just maybe one more kind of big picture question, and then we can check in with Robert, because surely there's questions coming in through the chat, and we want to make sure everybody gets a chance to answer. But one of the big concerns for investors is one, the environment, and then another is kind of asset allocation. And it was said earlier, the allocation between private investments and public investments. I personally, with the money I manage, have been very happy with the private side because it's offset a lot the public markets going down. And so maybe each of you could address a bit the advantages in impact of being private and doing either private equity or venture, and why that offers investors advantages as opposed to buying, ESG funds or impact funds, or just basically operating more in public markets. Specifically as regards impact, what are your advantages of being private and managing these vehicles?
In our particular case, we try to control the projects that we are in. We are not acquiring other people's projects. We are trying to have that. And for us at this moment is the only way to control really the impact DNA that we want to impress there, because we have all the strings. Obviously, there is a way to invest in companies that are aeolic equipment or things that are related to that matters, but in our humble experience, not necessarily all of them are really impact oriented or are really but is a way to approach. I'm not against that totally, but our approach is more on the private markets with projects that we control and probably that we can grow and go public. But they born and they grow with impact DNA and with the people clearly aligned in all this matter. It's a new way of doing business, a new way of thinking the matter.
Thank you. Anybody else want to say something about that?
I'm happy to add on to what Wally was saying. For us, the private aspect allows us to be more precise in the type of impact that we're targeting and then managing. We have more control over it. Where the locations are that we're going to build out forestry markets, and then linking in the local community. It's much more. It allows us to use much more patient capital to do so. We don't have to deliver results overnight, or even in a year or two, but we can invest now and wait for really to build up a foundational market that is sustainable and over the long term. So that's really important for us. We couldn't do this in a public in any way with using public securities. We're talking about forestry, obviously, and that's very illiquid in some regards.
Thank you, Justin. Anybody from Panama want to just add one thing to that?
Yeah, sure. I think from our perspective, and especially coming from Southeast Asia, the valuation reset that's happening to the tech space has kind of made it to be a very attractive entry valuation, especially for funds with the vintage in the last 2 years to start deploying this particular period. And then the second point is early stage VCs like ours. So we invest in, ranging between pre-seed to Series A. So there's multiple exit points for us. We do not necessarily wait until the eventual IPOs, where basically the growth stage investors are being, are quite suffering in this particular period. And we have been utilizing our right to exit via a secondary sale. So we remain quite optimistic about the long-term returns of the portfolio. And finally, with this approach depends and varies depending on the specific brand of the investment manager. But for us, our approach with early stage investment is that we don't spray and pray. So we do not invest in a large number of portfolio companies. We only invest in a concentrated amount where we can dedicate time to support and be quite hands-on from A to Z of the investment. So we think over the long run, that approach will pay us off.
Great, thank you. And maybe just Robert, do you want to jump in from the questions that are coming in through the chat? We got about 20 minutes to go, so.
Sure, there are two. I'll let you choose which you think is most relevant. There's one on the reporting side, comes from a family office here in Switzerland, and this may not be relevant for all of the funds, but how do you plan to address the upcoming EU SFDR regulation, whether you're sort of classified as Article 9, Article 8, or if there's another regulation more relevant for your fund, how are you sort of addressing that? The second is more general in nature. Which area of your business do you currently find the most challenging, either fundraising, perhaps originating, finding deals, or delivering performance on the financial side or on the impact side? So.
Why don't we start with the first? That's the big question. The second, rather, sorry.
I can start off. In addition to heading up impact at TIR, I also head up the ESG effort, and we do have an active fund in the European market, and it is Article 9. So it will be investing in the U.S. South and across timberland, as well as a variety of ecosystem services, like renewable energy development, conservation easements, as well as carbon. And that is something that is limited as an Article 9 to only sustainable investments.
Thank you, Justin. Can somebody, and some or all of you address the question, very good question about the big challenges you may face, either in fundraising or deal flow, deal selection, management? Where are the challenges along, I guess, the kind of continuum there?
Maybe I'll answer one thing and then let On take it. I think that one of the things that's been most interesting is as we've started to move into an environment where a lot more money is being put to work in the impact space, the question is, do investors and co-investors have the same amount of emphasis and care about impact as these companies are built and move on through their maturity level? So, we tend to invest very early at seed, Series A, and get very hands-on and back founders who really care about that. And then as you start building the capital stack on top, do the later stage investors in the capital stack who are coming into the business and are attractive investors for the founders continue to share that same mindset? So I think that one of the biggest challenges will be going forward is there are a select set of entrepreneurs who are, and I'm talking about this purely from a venture perspective, that are as charismatic and can build companies from soup to nuts and convince the world of what they're doing, and then continue to have the maturity in emerging markets with big fund managers to convince them that their vision is where they should go, and then have the confidence to pursue that without being taken off of their impact mandate a little bit. Not 100%, I'm not saying that that's the case, because we have a lot of great co-investors in later rounds who care as well. But I think that that is one of the biggest challenges that we're going to face going forward, is not do people care or not, but it's just, when push comes to shove and they start playing around with new ideas and they get to scale and they can use their machines to serve more and more people, but it may not be the highest margin. And then you've got fund managers who are trying to show that they should exist as well. And oftentimes they're judged on returns by their LPs, and they're trying to prove that they're worthy fund managers to be in the market. You get into the things, you keep going up and up and up on who you're answering to in the capital stack, and everybody can say, hey, maybe we'll do that later when it becomes easier. And then all of a sudden, we've essentially created a whole new ecosystem and a whole new way of operating businesses in emerging markets, and we haven't really changed anything. So I think that's the biggest challenge that earlier investors and founders are going to have to stand pretty strong and really use their leverage and bring in the right types of follow-on investors who care about what they're trying to do.
Very interesting. Anne, did you want to add on to that?
I think the most challenging task out of the one that it was outlined is actually brand building, and how to back to the misperception about being an impact investor. I think as other panelists have talked about in various parts of this conversation, a lot of time being an impact investor and fund managers being seen as, more on the philanthropy side and compromising on or not delivering any financial returns at all. So that's something for me is the most challenging part of the job.
And that for On plays not only when we talk to investors, but when we talk to other fund managers to try and get into the same deals as them, or even convincing entrepreneurs that we're actually in the business of helping them build big businesses.
Interesting. Anybody else want to jump in?
That is totally agree. And in infrastructure or in clean energy, right now is even worse, because a lot of money were already raised. And when I meaning a lot is really tens of billions in several of the fund managers. And then the quality of the project is suffering a lot. And to deploy that amount of money, and the European endowments is necessary, is compelling to develop good conscious projects, big enough in order to have critical mass to play the game. But the major challenge is not to create a green bubble, again, with pharaonic projects that doesn't make sense and doesn't take care really on the environment. I saw some of the big hydrogen projects that the use of water is ridiculous. Is not make sense for the community, for the region. But because our green hydrogen, everybody assumed that it's good. And we have a big challenge to try to be concentrated in develop good projects that make sense in all the meanings, sustainable in all the way, and in big size, because we have to develop 2-3 gigawatts of good projects in order to be really impactful. And we are doing that.
Thank you. Thank you.
I could add another perspective here too for what we're doing in the U.S. South. It's one of the biggest challenges is leveraging community voice. So the target beneficiaries, how do we hear from them on what their needs are? And something that is very important to many impact investors is not having someone come and a fund manager come into the market and think they know best and not ask the local community. And so we've partnered with a large nonprofit organization called the Local Initiative Support Company, or LISC, one of the largest community development finance institutions in the US that's active in rural community across the US. Most rural communities, they have a network of partners on the ground, typically nonprofit organizations that are active in the local community, that are staffed with the local community. And that's going to, they're going to play a part in our Impact Advisory Council. That's going to actually be help manage the impact on the ground. Not only how we manage our investments, across the value chain, but also how the profits that they're obtaining a portion of, how those profits are deployed in the community. And so they will have an actual active voice in the distribution of those profits, whether it's building out workforce development, building out affordable housing, chemical dependency, those sorts of, which are oftentimes going to be unique needs of the individual community. And so we're really tapping into that actively, and that's a part of the actual fund management.
Excellent. Thank you, Justin. Just to go back to Robert. Robert, any other questions come in? I mean, I have a follow on, but just to see other in the chat, anybody else?
And if there are no questions, I have, a question on just basic incentives. One of the commonalities of all of the private funds is really performance fee or carry. The first part of the question is, to what extent do your funds basically implement like an impact carry? And that's something that's new and coming into the market. That's one question. And on the company side, the actual entrepreneur, the business, the underlying businesses that have these KPIs in a plan to achieve, to what extent do each of your funds incentivize the actual managers to achieve those targets? So those two questions.
In our case, the incentives are very, very traditional. Then we cannot say nothing specifically on that, because all our people is very compromised with impact. Then we select a crew of people that is fantastic, that normally push us to go further. Then the motivation of the people is to be in a company that produce financial results, but that have a purpose, have a meaning, put a very serious thing. And we try to create that culture in our people and in all our projects. Then, unfortunately, to say now, our incentives are very carry oriented and similar things. We have more investment companies than funds, but we formatted like funds in order to be more easy to understand by the investors. Then we have management fees and carried interest in all our ventures.
Very interesting. Thank you. Bo, do you want to comment on that or on?
Sure. You know, we've, I mean, this has been an ongoing conversation for the last 10 years where, you know, we played around with these types of ideas. We've had conversations with people. We've never found that, you know, the impact investing space, you know, I think at a certain point, Richard, it will get to a point where there will need to be some sort of differentiation on the incentivization. We've been at this for so long, and maybe this is also a little bit what Wally was saying, was our set of LPs have spent so much time with us and have just spent so much time with our portfolio companies and with what we're trying to do from a thesis perspective, that they know that that's at the absolute core of what we do. I do think in the future, there will be opportunities to do this. I haven't seen it done well yet. And also one of the challenges is, if you were a very large fund manager, I think you could potentially have, and coming from the commercial side as a starting point, you would potentially have a more interesting opportunity to implement this, as opposed to having, you know, fund managers who are not your, you know, name brand fund managers who are trying to move the whole entire investment industry in a certain direction. So what we're trying to do is make this as palatable and digestible for people as possible, both on the LP side, meaning the investor side into our funds, and without it making it seem like we're trying to do something funny of giving ourselves more money if we have better impact. Or, you know, I've even had some folks say, man, one of my biggest worries about you guys is you're not going to be making as much money as some of your more traditional counterparts. How am I going to be sure that if we start really changing this, that you're going to stick around? So that's one thing. On the entrepreneur side, I actually think that there's a major challenge there as well, which is unless you are sure that there's a capital stack in place further up the value chain, meaning moving from A to B to C to growth stage rounds to PE rounds and everything. If you try and do too much that seems highly nuanced when it comes to incentivizing management to do different things on the impact side, you make these companies look not like companies in the minds of a lot of potential investors. That you start to see them as this, you know, is this really a company, or is this like a nonprofit dressed up in a company? But I do think in the future, these things will be possibilities and opportunities. And I do not mean to say that they're bad ideas. I'm just saying we have not seen them come to reality yet in a way. I think bigger players could move it in that direction, but the very dedicated and scaling fund managers in the space have not been able to accomplish that to date.
Can I jump in, just because we're getting close to the end? I just have a question for all of you. What is the most limiting factor that you face? Is it funds available to put to work? Is it deal flow and viable companies that are attractive enough to invest in? Is it resources in the teams to be able to manage and you know, find the best people and so on? What are the constraints, or both that you feel in your funds and just what you sense in the industry? What are the bottlenecks? I mean, I can say, you know, I personally, you know, put money to work in the real estate market. It's been very difficult to find good deals for a lot of different reasons. And so I'm wondering whether you're up against those things where, you know, where are the limiting factors? Is it that you have money you can't put to work? There's not enough deals that meet your standards? Are there too many deals, not enough money? What is it?
I'd say for TIR right now in this impact strategy that we're talking about, scale is definitely going to be the biggest challenge. We have to achieve a certain level of scale in these rural markets. If we're so how much we'll invest in one market across the forestry value chain is often going to take over 50 million alone in one community to build out a sustainable forestry market. And that, so that's, you know, you're looking at then any type of a portfolio or fund that's multiples of that to make sure that we have sufficient diversification across multiple communities and types of wood markets that we're able to build out. So that's a big factor that we're hopefully able to meet that challenge with some of these very large foundations in the market.
Hope so. Yeah. Others similar problems or different problems?
From our perspective, deal flow in this space actually not a problem. So we do see a lot of deal coming through, especially when you're looking at, you know, early stage technology startup ideas, usually focus on the mass market consumers, which we are after or servicing or accelerating the small and medium enterprises digitization. So we're not concerned about deal flow. For us, the limiting factor at the moment is getting more money to put into work. We feel there are much more that we can do and much more impact to be generated, especially in this part of the world.
Thank you, Anne. Any other comments on that? So it sounds like more resources, more
No,
investors.
It's more investors on our end as well. Deal flow is not the problem. It's it's not only finding the resources, but the right resources as well. Finding those investors that want to see this this progress and want to come with us down this path. So I think this is the finding of that specific match and having long-term partners with common vision.
Well, on that note, we're coming right towards the end, so that actually gives a good impetus for future calls like these. To be honest, not to promote, you know, this as such, but you know, these sorts of calls are designed for that purpose, right? To help people identify their interests, to help drive them towards investments in impact or in sustainable areas. And so, you know, hopefully it'll lead to more things in 2023 and beyond. And, you know, and again, these are useful because everybody is sharing and providing good insight. So Richard, do you want to add anything? And we're going to have to let people leave as we promised promptly at 4 o'clock.
No, I think, Greg, this has been a great session. And to your point, you know, this really is leads on to really the dialogue, this asset owner and GP impacted investors that dialogue together to identify really really future possibilities to work together. And so we'll be continuing to do that in this great session. Thank you very much, everybody. Yeah.
Thank you, everybody. Happy holidays to everybody.
Thank you, everyone.
Thank you. Happy holidays.
Thank you, everyone. Thanks for joining. Take care.
Bye, guys. Thank you.
Take care.
Bye.